about the week past and outlook for the week ahead. We do have some very common ground between our two speakers this Sunday, as they both are sitting on political turmoil, with the Australian Prime Minister just announcing an election and the Pakistani Prime Minister just ousted, all within the last few hours. So quite a coincidence. So I'd like to sort of drill down a little bit into that, given the proximity of the two speakers to these two stories, because they do resonate, I think, to the wider narrative where the global economic outlook might be. We see today also the first round of the presidential elections in France, coming after recent election surprise results in Hungary. I think one common narrative through all of them has been and will be, what's the price of bread in the corner shop? So let's kick off this morning with Maliha Bengali, founder at MB Commodity Corner, international fund manager, but currently today sitting in Pakistan. Maliha, what is the story in Pakistan today with the removal of Imran Khan? He thought he got away with it with calling for an election, but he was dragged back into parliament and voted out of office. What's that mean for Pakistan today?
Thank you, Sean. It's a great question, because as I got here about 5 days ago, this country is rife with, coup d'etats and military law since our independence. What Imran Khan has been voted in for the last few years, we were very positive on the visionary that he had for the future. But unfortunately, as I was telling Peter, he hasn't really managed to achieve much in the last 3 years, and his cabinet has lost confidence in him. Having said that, he did something unjust by dissolving the assembly, and the Supreme Court have actually ruled against him by saying that what he did was unfair. And now with the vote of confidence he passed through last night, he's been ousted. We're going to have another general elections right now to see if he may come back in power, but the assembly is so convoluted and corrupt that we need a reflush of the system. We'll see what ways to happen, but this is probably a better surprise in terms of getting elections, new elections right now, because what he was doing was a lot of finger pointing, a lot of laying blame, but there was no evidence as to the fact. We know there's corruption and bribery here, but he did actually do what he set out to do in the last 3 years. He just talks a very good game.
Pakistan, a country of over 220 million people, sort of fairly large population, and much of it at the sort of front end of sort of daily economic challenge. How big a moment is this in the country, and what is its interconnection with the politics in terms of the rate of food inflation now reaching record levels in March, up 40 to 50% so far this year already?
We've always had very high inflation between 13 and 15%, but you're right, this last year has exacerbated to like north of 40%. There's massive wealth inequality. Politically, the country has always been torn between the East and the West. As you know, our allegiances lie with the US many, many years ago. And over the years, China has been playing a very strong influence in our country. They own a lot of our debt, the One Belt, One Road initiative. We are a very key strategic partner to China within their incentive. So there's a bit of political animosity in terms of what direction Pakistan will take or could take, because obviously it's quite contentious in terms of the Talibanism, Afghanistan. Pakistan's always been the bedrock of all that sort of political, volatility. But the future of Pakistan right now is wage income growth, inflation, food security. We need to get those in order. Our debt is very high. We just need to get those policies in order, and hopefully the new government will actually do that for us. But we shall wait and see.
Let's welcome Peter McGuire, CEO of XM Australia. Peter, Scott Morrison just called an election this morning. What's the outlook for that? Why did he do so? What's the timing, and what is the outlook?
Good morning, Sean, and thank you, Maliha. The outcome, or we're probably around about 5 weeks away, Sean, from blast-off date for Mr. Morrison. I'm not sure what the electorate's going to think of him. There are very mixed bags around here as far as Australia's political views, certainly towards Morrison. Being called in public forums a bully, misogynist, and these sort of statements that certainly haven't gone well with the electorate, and certainly not with the female voters. So that's going to be interesting. The platform that he demonstrates over the weeks ahead It's going to be very, very close call. Many pundits are saying that he's actually behind the Labor Party. There's a lot of independents that are gaining groundswell due to the management of COVID and the debt that was racked up and the way that Morrison's run things. So it's a very interesting bag at the moment for Mr. Morrison. He hasn't got a lot of friends.
The opposite, in some ways, the opposite of Pakistan, in the sense that obviously Australia is benefiting dramatically from all of these record high commodity prices. So that must be a lot of wind in his sails for re-election, given the strength of the Australian economic performance in this period of, as I say, record commodity prices.
Well, that's exactly right, Sean. It's been wonderful for the country and certainly for producers, but not for the, again, the electorate. We've seen very, very little wage growth. We've got inflation, I would say, realistically, and you talk to the man and the woman on the street and the young, you're probably in double digit, might be 15% when you're thinking about what the price of meat is and bread and utility costs. So if you really look at the true basket of what you're buying and fuel costs, they're just blown out to the upside. Coffee from $3 to $4.80, all within 20 months. So we've seen huge moves to the upside for all basics, and the electorate is certainly not enjoying that. Plenty of work out there because we're not opening our doors really to the to international tourists or international people that want to come to our shores. So it's a slow drip feed. So it's going to be interesting, Sean, how this progresses over the weeks ahead.
Malia, perhaps more consequential on some level than the elections in Pakistan or in Australia is what happens in France today, with the potential that the far-right candidate Marine Le Pen is expected to get into the second round, but ultimately the consequence for Europe, if she was to win election vis-a-vis Ukraine, vis-a-vis the euro, how consequential do you think this election is in France, especially when one thinks of coming on the back of the surprise result in Hungary?
You're absolutely right. We're waiting to see what the results are. There are two schools of thought. It's a bit early to say right now how that's going to proceed, but we see two different scenarios unfolding. It's a tough one, but the political policy in terms of the Russian relationships, oil import ban, coal import bans, currency, ECB tightening, all these things have massive repercussions as to what will happen. The market really is at inflection point here. Other reasons other than just the geopolitics, but these are making it a lot harder for us to predict. But you are absolutely right. That's going to be a key influence going forward.
In that point, Peter, the euro weakness seems to be a dominant narrative in recent weeks. Obviously, with the war in Ukraine, what would your outlook be given the outcome of the French election, if indeed polls are going in Le Pen's direction at the moment?
I think if Le Pen wins, Sean, it's going to, I think, certainly disrupt a lot of the current frameworks around not only the ECB, but I think it's going to send a little bit of a hand grenade across all of Europe. So there's the first part. The second part is, as far as that euro, we're going to handle under 109 now. US dollar index just shy of 100. As we know, that's weighted at around about 61% of that US dollar index is euro weighted. So I think it's hit most traders by surprise what we experienced in March. Big sell-offs with yen, big sell-offs as far as, or softness as far as euro, and it's marching towards parity. I'm not suggesting it's going to get there, but if we don't see a rate rise and we see a couple of consecutive big hits from Jerome Powell, a 50 and a 50 basis point rises in May and possibly June for the Fed, then that would push I think, the dollar up further, euro continued softness, and maybe a 105 handle is where we're at, well down from what we only a few months ago we're at a 122. So it's been dynamic for traders.
Malia, given that point, and just sort of taking the outlook into Asia in terms of where oil prices may go, we traded down again last week, although Brent closed above $100 on Friday, 102 and change. My question is ultimately, what is the cumulative effect for Asian consumers? We just talked about inflation and Peter saying double digits already in Australia. and probably climbing across Asia. Now we've got a record, but certainly elevated dollar, which of course for currencies and economies in Asia buying all these commodities in dollar, that's an extra layer. And now we have rates rising in the US, which is going to make dollar denominated debt across Asia a extra kick. All of those things together, where does oil demand in Asia go over the rest of this year?
Sean, that's a great question. Demand destruction. These are the two words that I go into every meeting asking people to focus on. We are so focused on the supply side, the supply tightness. Not many people are able to construct a framework where we see demand destruction going forward. So I have 2 points. The first point is the data on the 4-week basis from the IEA and the EOE right now, we are seeing a decline. The rate of change of demand on the 4-week moving average basis is falling down. We're already seeing some signs of demand destruction. It could be that we sort of left the winter season before summer season starts. We're seeing distillate demand falling a little bit. Inventories are actually tight, but demand is the key thing to follow, because on the macro side, by the time we actually see the demand destruction, prices are already corrected 20-30%. I think that is where the market will forget the fact that we will see from Asian demand, emerging markets, dollar is a big factor for a lot of these countries, and the demand will, eat into the numbers going forward. And now we have the US SPR release, which is in a very timely fashion. We're adding about 1.5 million barrels per day to 1 million barrels per day to the market at a time when Russian exports are actually not done more than 1 million barrels, and US OPEC and supplies are picking up. So the market balance is tilting slightly into a surplus rather than a deficit for the last few months. And demand destruction will be the key factor that will determine that balance to move more into a surplus. The other thing is currency markets. You've seen the yen right now. No one's talking about how this competitive advantage yen and other currencies are having is going to impact on the yuan. The yuan is very, very strong right now. And at some point, there's a lot of pressure for the yuan to do something about that. So the market on the FX side and demand destruction, people need to take a lot more focus as what's going on there. That will determine the price of oil. And I think that could be a little pressure going forward.
Well, looking at that, Peter, the yuan, the Chinese currency, of course, the big demand destruction story seems to be led by China under the weight of the Omicron COVID outbreak. Now Shanghai in total lockdown for 2 weeks. And yet over that 2-week period, we've seen infection rates in Shanghai grow by a multiple of 5 while the city has been in lockdown, and others across the country following suit. How big a challenge do you think this is to China and to the outlook for Chinese oil consumption in the coming quarter?
It's got to be very concerning, Sean. First off, from the health aspects, as you mentioned, 5 times multiple of 5. So where are we in a month, and does it affect other major cities? And there are, numerous Shanghais across China. So there's the first part, and what impact it has, building on Maliha's comments as far as demand destruction and a strong yuan. They're the perfect ingredients for, I think, more continued volatility across that complex and big swings, the 5 to 10% moves, which won't be uncommon over a session. So it's very difficult to put a headline number. Where do we see crude by such and such date? It's more to do with what size volatility are we going to experience over that time period till we get to that date. Because you can just see such huge swings that really, I think, change the footprint from most consumers' point of view. They're just not sure what they're hearing over on a radio or a TV or a newspaper to the price of crude. It's so volatile.
Maliha, it does seem that volatility is caught between the narrative of supply disruption concerns, given the outlook that that we still have yet to see the Russian disruption. Most volumes remained pretty much as normal in March, but now coming into the second quarter, that's expected to really spike up in terms of Russian oil struggling to find access to market, at least 1 to 3 million barrels, depending. And then the demand destruction we just articulated already. There are sort of independent secondary sources calculating Chinese demand destruction is down 1 or 2 million barrels. Where do you see this battle going vis-a-vis Russia, supply disruption, Asian demand destruction? Which of those is going to win out in terms of the direction of crude oil in the second quarter?
So in our view, we built a macro model looking at a host of macro factors affecting demand destruction versus just the supply side. So on balance, we see demand destruction and Asian demand taking oil prices a little bit softer in the near term. The next 1-2 months is a little bit more precarious. We already know what Russian oil is doing. It's actually just being rerouted away from Europe into China and India. China's taking about 500,000 barrels more. India's about 1 million. China about 1 million barrels per day more of oil. So that oil is still pretty much in the market. It's demand that's going to be worried for us. Let's forget about the US Fed. They're raising rates aggressively now, and the 30-year mortgage rate, the US bond market, the volatility in the cross-asset market is so elevated. Equity market vol is very complacent. We think the cross assets are signaling a sort of a worrying time for equity markets. And I think that volatility, that excess volatility is going to be put into equity markets at some point. The bond market's a big concern for us. So we think demand destruction will be the fact that takes oil prices a bit lower in the near term than on the supply side.
Let's get the question in, a survey question to sort of get the view of the room in terms of some of these issues. Global food prices are surging, fastest pace ever in March. We're already up at fairly high levels on food, up 30 to 40%. What is a bigger threat to global economic growth going forward this year? Is it food prices or energy prices? Inevitably, they're quite interlinked in some ways, but ultimately not. I mean, food prices are accelerating on the back of major supply disruption. Ukraine, it's expected at least 50% of the harvest will not get out of Ukraine this year, never mind the plantings for next year. So which is a bigger issue for global economic outlook, food or energy prices? That's the question this morning. Peter, looking at the week ahead, there's a few things on the horizon. One is earnings season, and the banks in particular are expected to kick off tomorrow. What's your outlook for earnings, and how is that likely to impact confidence, the momentum of the equity markets in particular?
Well, I think overall sentiment, Sean, it's got to be quite, I'd say, bullish as far as earnings to satisfy the nervousness across the market. We've got couple of central banks also meeting this week. So you've got the tick up as far as the Fed and its rate rises and aggressively over the next, say, 3 to 6 months. And how do earnings perform? Certainly the financial sector. Are we going to shoot the lights out, or are they going to underperform or underwhelm? And market sentiment at the moment, we saw that quite a heavy sell-off as far as NASDAQ and a number of the, if you're looking broadly, the S&P and the Dow over March. We've had a little bit of a rebound in the last week, but it certainly was shaky. Also, we're leading into Easter this week, so that's going to take, I think, I think in some ways that could be a quieter week than what a lot of traders are expecting. So yeah, earnings, looking at the numbers, waiting for them to drop, and the sentiment associated with either it's going to be fruitful or underwhelming.
Maliha, just to follow on from that, do you think the equity markets have sufficiently priced in yet what the Fed is signaling? I mean, it seems to me the Fed is being compelled to be even louder in its pronouncements about a more aggressive tightening cycle because the equity markets fundamentally have totally ignored him up till now.
You're absolutely right. I do not think the equity markets are priced in how strongly committed the Fed is right now. The Fed's going to keep on going till something snaps. Either equity markets fall by 10 or 20%, or something, the financial system will collapse for them to reverse their policy. A lot of people are saying it's priced in because they think they're going to cut very soon. We don't think they're going to get close to 3-4%. It's not going to happen, but they will keep on that path until something changes, because inflation is the big issue. If you look at the Fed funds rate right now and CPI inflation, we should have rates close to 7 or 8%, but we're not going to get that. The market will not even take more than a 2% increase possible. So I think the equity markets have not priced that in. The reason why the markets have been pulling up is because buybacks have been very strong. We're now in a blackout period, so we'll see how that sort of impacts equities going forward. The Fed balance sheet is not growing anymore after April 1st this year, so we'll see how that supports the market as well. And then the US bond market, the 10-year yields making 2.72% new highs. We're breaking through a massive downtrend from decades. How is that going to affect the equities, especially the technology sector? We know higher yields have been bit of a headwind for technology. So all of these factors are quite bearish for equity markets. And I think this complacency, or the Fed's going to support us, is actually a bit misplaced because they are short the call. They're actually not long the put right now. And they're going to keep going till they get the right number. Inflation either goes down or something sort of snaps in the market. That's our view.
Peter, I'd welcome your thoughts on that a little bit. Strikes me, I'm not convinced Jay Powell has the cojones, as they say, to sort of take on the challenge of inflation and get rates up. Ultimately, he is a dove when it comes to rates. Your thoughts? Does he have it? Does this Fed and his board members have what looks like necessary to tackle this sort of record or elevated inflation?
Well, Lael Brainard's comments are far more hawkish, Sean. So, and we believe that Lael Brainard will actually take the deputy chair role. So there's the first part of it. The second part is building on Malila's comments. Yes, certainly earnings, how they're going to be impacted with higher yields, and how aggressive is the Fed prepared to be. We sit here and we say, well, if inflation, if you put the old measuring tools, it's a lot higher than what it should be at 7 or 8%. And if that continues to build, higher energy costs, high food costs, supply lines and supply chains being crimped, and crops and so on, then this really creates, in some ways, a perfect storm. The other side of it is, as you aggressively move rates higher, what happens to growth forecasts? We all already understand that Europe could be facing a recession in third quarter. So is that going to be a similar mindset or a similar course of events running across the US and other major markets later in the year as far as recessionary fears, which is the big word that we spoke about last time I was on together, stagflation.
We have this week now, I mean, Fed obviously is the 10,000 pound gorilla in the rate room, but we do have New Zealand central bank meeting this week. We've got, I think, the Canadian central bank, even the ECB. What is your thoughts on where they may move, if they will at all?
Well, as you said, we've got the trifecta. I'm not expecting any surprises out of the ECB. We heard last, I think a couple of weeks back, as far as balance sheet and what they're prepared to do as far as, moving forward. So I'm not, again, expecting surprises, but certainly from Canada, 50 basis points. That's what the analysts and pundits are all, saying is going to materialise. And the same for the Kiwis, Sean. So that we're off and running, 50 basis point hikes, and that might be the new normal. If they do 50 and then you've got the Fed doing 50, I sit here in Australia going, well, maybe it's no longer going to be a 25, it's going to be a 50 first cab off the rank. So yeah, this week would be an interesting, that short week, 4 days leading into Good Friday on Friday, of course.
Malia, this does reflect in a way a shift ultimately. I mean, we have many things going at the same time. Even obviously the Ukraine war is still the most dominant sort of weighting in the global economic outlook, but the tightening, the moving from what has been a decade of ultra easy monetary policy, and that's been on steroids through the COVID crisis, to now one that looks like for the first time in probably decades where we could see a series of 50 basis points, but a very robust tightening ultimately. This is a shift in monetary, and I'm just wondering how much of a shock do you think that will be, or structurally, how does that affect the axis of the global economy?
You're absolutely right. I think the generation of traders right now have gone used to trading a world of deflation. Rates keep going down, equity prices keep going higher. It's been a very sort of easy scenario to trade. We've never dealt with stagflation or recession. The Fed started raising rates back in 2018, and we saw the repo crisis back in 2019, which forced the Fed to reverse their policy and start pumping money into the market. And that's when rates got to only 2.4%. So every time the Fed goes on to this path of raising interest rates, something snapped. The system has got so much debt over years and years of this MMT experiment. It's very hard to say, but we know that the system cannot handle higher interest rates for very long periods of time. But the only problem is how much can the Fed print now? What tools do they have? Which is why they need to raise rates so fast. So eventually something happens, they have room to ease. Right now, rates at 0.5%. They can't possibly do anything else, which is why they need to do something so they can tackle another crisis. But we do feel the system is very levered, and it's in a situation where markets not used to trading in a stagflationary / recession environment. It's not as easy as before.
Do you think, Malia, whether intentionally or not, but perhaps intentionally, that the Fed needs to push the US economy into a recession?
That is a very dark question, but in our view, we think they have no choice. They have to get asset prices lower. The big word that we talk about, the global reset, which is something you'll hear a lot of economists talk about, or traders. We don't know when that happens, but this MMT experiment fails. The global reset could be this year, it could be 2 years from now. At some point, these prices need to come down, and the Fed has no choice but to either reset the system or at least try to. It's the only way to grow consistently going forward.
Peter, the big sort of outlook opportunity perhaps for energy demand in Asia and China in particular is the fact that the Chinese government may be compelled into a very significant stimulus program coming out of this COVID moment that they are in. Ultimately, we've seen Omicron blow through a lot of places here in Dubai, all over the world. It came and went ultimately. And
Yes.
one has to expect it will do so in China. When it does pass through, the other side of it could be a very bionic recovery of that sort of V, if you like, with Chinese muscle to spend. Your thoughts on where China might go in the backside of Omicron regarding further stimulus in the second half of the year, particularly when you have the Communist Party election in the fourth quarter?
Absolutely, Sean. So first off, yes, I won't be surprised to see massive stimulus. The other side we've got to be conscious on as far as the property sector, which makes up such a large component, I think it's around about 30% of GDP of their domestic economy. So you're looking, and still to work through some of those large developers that are under large financial strain, to put it mildly, the Evergrandes and so on. So that's got to be a consideration that's got to be inhaled. And then the government is going to be, I believe, due to naturally the Omicron working through, and if it can be isolated only in that Shanghai region and it doesn't blow across to other, and we're coming into summer, so that's a positive. Then if that can be constrained and contained, it's going to be a plus for China. And I think that the government will action a very aggressive stance as far as stimulus. If it was to become a far more dramatic situation, Sean, that it engulfs many different cities across the vast landscape of China, then that changes the footprint as far as what and how they action those remedies moving forward. Time will tell.
Time will tell, indeed. Let's get the survey result and give Malia the last word with a week ahead outlook. The result of the survey is food prices 2-to-1, much bigger impact. Malia, I'd like to just end where we started, looking at the Pakistan. Obviously, tomorrow morning, expect to have a new prime minister until elections are called. It's expected to be now of Sharif's brother, who brings the Sharif family back to the front end of the political power in Pakistan. What does that mean vis-a-vis, do you think, for the neighborhood, the Middle East, the Gulf, India, and Afghanistan, vis-a-vis where Pakistan goes? Does anything change?
It's a great question as well. Well, we know in the past, the Sharif brothers, or the NTP, that party's done a very good job for the North and Punjab. The economy grows. They're very sort of financial based, economic based. The focus has always been on agriculture, GDP, and revenues. Economically, they do really well for the country. So if you look at the past sort of precedents, I think it would be a very good start for Pakistan in terms of what's good for Pakistan economically. To talk about geopolitics is a bit early right now. I don't think we're going to break away from our allegiances towards China and the region. And Gulf regions, it's very hard. But right now, the focus is economically, they will do a very good job for our country, as they've done in the past, we feel.
Well, it certainly, the Imran Khan was making noises that the fact that he went to Moscow on the eve of the invasion of Ukraine, that the Americans were not happy and sort of manipulated his exit. I'm not sure if that's one and one is two there, but clearly there is things at play vis-a-vis the Pakistan alliance and alignment. But ultimately, one would have to say those powerful decisions typically anchor with the military and defense in Pakistan and don't change much from prime minister to prime minister. At least that would be my general observation. Malia,
Absolutely
thank
right.
you very much for your contribution today. Great to have the chance for a slightly deeper, longer chat with you and Peter, digging into these issues, and particularly given on the eve of earnings season and where all of these issues are colliding with oil prices starting the week at a little bit above 100 on Brent. I'm not sure they'll end the week above 100. It feels to me like the tendency of this market wants to go down rather than up, despite the shock and awe that continues in Ukraine. Have a great week, everybody. We'll be here every morning, 10:30 UAE time. All the best. Thank you.
Thank you, Sean. Thanks, Malia.